Since being launched over 4 years ago now, the JPMorgan Equity Premium Income ETF, ticker JEPI, has easily become one of the most popular high-yielding dividend ETFs. It pays out monthly dividends and offers a yield that typically ranges between 7% and over 10%. Additionally, this ETF has offered better share price upside than other covered call funds that exist. Since its launch in May of 2020, JEPI's provided a total return of over 62%, or roughly 12.42% per year up to this point. Those are pretty good returns from a fund that offers such a high yield. There's a lot of high-yielding investments out there that haven't offered these kinds of returns. But there's been a phenomenon with JEPI over the past 2 years that's left some people concerned based upon what I've read on websites like Reddit and Seeking Alpha. If we bring up a chart of JEPI's monthly dividend payments, you'll notice that the dividends this ETF's been paying have slowly been going down over time. Between 2021 and 2022, JEPI saw a really impressive amount of dividend growth, and 2022 was the year the S&P 500 was suffering due to interest rates going up. But starting in 2023, JEPI's dividends slowly started to go down. This ETF doesn't pay a consistent dividend from month to month, so some months it would increase and some it would decrease. But there's been a very noticeable trend as time goes on, where the dividends have been continuing to fall. Compared to late 2022 and today, JEPI's dividend amount has nearly been cut in half. It was paying roughly 61 cents in late 2022, where it now pays around 32 cents per share. And that's all the while this fund has seen its share price grow. These falling dividend amounts have left some people concerned about whether JEPI is still a holding that's worth considering for people who specifically want a high amount of monthly income, because we've all been seeing the yield of this ETF go down over the last year. So in this video, we'll take a deep look at this ETF and we'll understand how the dividends are determined, why they've been going down, and if JEPI is still worth considering for income-focused investors. For starters, a lot of people think that JEPI is like your typical covered call fund that exists. With an ETF like XYLD, when the index this fund writes covered calls on goes up, so does the share price of XYLD, and the dividends also move upward. And then during periods where the S&P 500 falls, both the share price and the dividend amounts fall as well, typically. And so some people assume that when the market is rising, that JEPI and its dividends should also be rising. But what we've been seeing with JEPI is that while the market as a whole has been going through periods of really solid growth, the share price of JEPI has been going up, but the dividends have been falling. So what exactly determines the amount of dividends this ETF pays? One source of the monthly dividends comes from the dividend holdings that are inside this ETF. If we look at its holdings, we can see it holds a lot of dividend-paying stocks like Progressive, the Southern Company, and Microsoft to name a few. But this is typical of all covered call funds. They all pass on the dividends they receive to their shareholders as part of their monthly distributions. There are, however, two unique aspects of JEPI that set it apart from other covered call funds when it comes to determining how much they pay in dividends. The first is that this ETF holds more than just stocks. It holds another type of investment called equity-linked notes. These are debt instruments, but they function differently compared to your typical corporate bond. They're not fixed income securities, but rather they pay a variable interest rate depending on the performance of the equity that they're connected to. If we look at the total portfolio holdings of this ETF, you'll see it does hold a bunch of these investments. These ELNs were issued by JPMorgan, and there isn't any information that we can look up to see what's inside of them. So it's possible the interest rates that these ELNs have gone down in recent months, but it's almost impossible to know that for certain. But what's likely to be a much bigger driver of the decreasing dividend payments from JEPI has to do with the VIX, which is the SIBO Volatility Index. It's a popular measure of the stock market's expectation of volatility. Volatility measures the frequency and magnitude of price movements in the stock market. The VIX index is recognized as the gauge of the US equity market volatility. If you go to popular stock websites like Yahoo Finance and CNBC, they usually display it on their homepage. What's important to know is that when volatility is very high, then the VIX usually rises, and when the VIX rises, then stock prices usually fall. When the VIX index falls, then share prices in the market typically rise. There isn't a perfect inverse relationship going on here. There can be days where the VIX was down and so were stocks. But the majority of the time, they are correlated with each other. The number one way to know how much JEPI is going to pay in dividends is how much the VIX index has been soaring. Let's pull up a chart of the VIX index and see how it's been doing over the past few years. You can see it soared during the pandemic, and it has surged at certain times since then. Since late 2022, the VIX has consistently been moving down, and it's been pretty flat for all of this year, with the exception of what happened in April. If we pull up the bar chart of dividend payments, the movements of the VIX index have been pretty comparable to the dividend amounts offered by JEPI. There have been spikes in the VIX, but especially this year, it's just been flat. The fact that the dividends are more dependent on market volatility likely confuses people who encounter this. If we look at a different covered call fund like QQQI, which is the NEOS Nasdaq 100 ETF, the share price has gone up a bit this year, and so have its dividend payments. JEPI is not tied to an index, which makes it different from other covered call funds as well. It's an actively managed fund, and the managers pick investments that fit their own guidelines. So ultimately, JEPI is a fund that's continued to perform as outlined in its prospectus. And if you think about it, it's actually been a pretty good way to hedge your portfolio. Because regardless of how the market is doing, it does one of two things that benefit their investors. When the market is climbing and the VIX is going down or it's flat, it does usually result in lower dividend payments. But the good news is that the share price will climb higher, so there is some appreciation for your investment. When the market is going down and the VIX is up, then that can lead to its share price falling, but on the other hand, the dividends will likely start growing much higher. So there's a benefit to holding JEPI regardless of how the market is actually doing. It's true that if you are looking strictly for very high and consistent income, then this ETF might not meet your expectations. But if you saw the variable dividend amounts before you invested, you already know that its dividends can change depending on the market. I also want to bring up something that I think is worth mentioning. JEPI is an actively managed fund that has two fund managers, who are Hamilton Reiner and Raffaele Zingone. As of the making of this video, both of these fund managers have each invested over 1 million of their own money into this ETF. It's a pretty good sign, in my opinion, when the fund managers are putting their own money where their mouth is. Specifically with an individual stock, a high insider ownership percentage is a good sign of confidence that the management team is really optimistic about their company's future. It obviously doesn't guarantee good returns, but I think it's a good sign when the managers are willing to put a large amount of their own personal fortune into their own fund. But with that being said, JEPI is still a good holding for income-focused investors. Whether you're retired and looking for some more income or just love a monthly paying investment, then it's a good consideration for your portfolio. Although the VIX is currently pretty low, it will eventually go up again. Throughout its history, it's had other long spells of flat movements, even less movement than what we're seeing right now. Another attractive feature of this ETF that I haven't even mentioned yet is that it's designed to be much less volatile than the overall market. Right now, according to Morningstar, JEPI has a beta of just 0.59. If a security has a beta of greater than 1, it's more volatile than the overall market. If it's less than 1, then it means it moves much less than the overall market. So at 0.59, that's a pretty steady investment. That can make it even more appealing if you're more concerned about capital preservation. But in summary, nothing's wrong with JEPI. The dividends are going down because of less market volatility. When volatility returns, the dividends will pick back up, and its low market beta should result in less dramatic share price swings. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.